Usually, when we look at commercial real estate data, you kind of expect to see these massive multi-level office buildings or, sprawling industrial parks commanding the truly jaw-dropping
Right, the
numbers.
stuff that makes the headlines.
Exactly. But then you actually dig into the data, and sometimes the biggest shocker is, well, it's a fast food chicken place.
Yeah, that really stood out this quarter.
I mean, we are looking at a newly constructed single-tenant Raising Cane's. It's a quick service restaurant on North Newport Highway, and it just traded for roughly $4 million.
And, the top line number grabs your attention, but the underlying metric there is a 4.6% cap rate.
Which is wild.
It is. In a secondary market, paying $4 million at that specific cap rate, that translates to nearly $1,300 per square foot.
I want to pause right there just because we
Mm.
throw around the term cap rate constantly on this show.
Fair enough, yeah.
For anyone listening who doesn't live and breathe commercial real estate formulas all day, let's ground this a bit. A cap rate is essentially the yield or the return you would get on an investment property in a single year if you bought it entirely in cash, right? Zero debt.
Exactly. Completely debt-free.
So a 4.6% cap rate means if you pay $4 million in cash, you're making a 4.6% return on that money annually.
Correct.
So my question is, why is someone willing to accept a relatively low 4.6% return just for a drive-through right now?
Well, it really comes down to comparing that return against the cost of capital. Your baseline borrowing cost in the economy right now, like the 10-year Treasury yield, it's sitting right around 4.35%.
Wow, so they are barely beating the Treasury.
Right. Seeing an investor willing to buy an asset at a 4.6% cap rate, which is, like you said, barely a sliver above the baseline cost of money, it demonstrates this massive flight to quality.
They just want safety.
Exactly. Buyers are incredibly hungry for absolute stability. They want a corporate-backed rent check that never bounces, and that desire is just completely overriding the higher borrowing costs we're seeing in the broader market.
So they are essentially buying a bond that happens to serve chicken fingers.
That is a great way to put it, yeah.
Well, welcome to today's deep dive. We are looking specifically into the Spokane, Washington retail commercial real estate market for the first quarter of 2026.
Lots to unpack this quarter.
For sure. And for geographical context, this data often ripples over the border into neighboring Coeur d'Alene. We will be keeping our lens primarily on Spokane today, but, the CDA market is always a major factor in this region's broader economic footprint.
Oh, absolutely. It's a highly interconnected regional economy, and the capital flows back and forth across that border constantly.
Right. To give you the lay of the land, our insights today are drawn from a really solid stack of sources. We're looking at CoStar Capital Markets data, some internal data, and a highly detailed Q1 2026 research brief prepared by Eric Peterson.
He's a broker at ACTIV8 Real Estate.
Yes, exactly. ACTIV8 Real Estate. And look, if you're a property owner or an investor and you want to dig into how this exact data applies directly to your own portfolio, you can actually reach Eric directly at 509-903-9077.
And having a localized breakdown like that is critical right now.
Why is that?
Because the headline numbers in this quarter's report paint a picture that, honestly, it doesn't really match the reality on the ground.
Okay, let's get into those numbers then. I'm going to run through the quarter in a minute for you. We have 4 big headline bullets drawn straight from the CoStar data for Spokane retail.
Let's hear them.
First, vacancy is sitting at 5.4%. Second, net absorption is negative 222,000 square feet.
Which sounds terrifying.
Right. Third, sales volume over the past 12 months is roughly $114 million. And finally, the market cap rate is averaging 7.4%. So when you take all of that together, what is the actual narrative here?
Well, on paper, a negative absorption rate and a 5.4% vacancy rate look like a market in full retreat.
Yeah, it sounds like businesses are just shutting down left and right.
Exactly, like they're just empty storefronts everywhere. But if you look under the hood, Spokane retail is actually demonstrating this remarkable structural stability, and the entire transaction market is being kept afloat almost exclusively by local private capital.
Okay, we need to unpack that negative 222,000 square feet of absorption. I am honestly struggling to reconcile that number with what we hear from business owners every day.
It is a massive disconnect, for sure.
Because anyone who has tried to lease a prime retail spot lately will tell you that space is supposedly impossible to find. So where is this massive hole in the data coming from?
So we have to contrast the national macroeconomic trends against a few very isolated local events. Let's pull in the national sector report data first to set the stage.
Okay, what's happening nationally?
Nationally, retail development has effectively ground to a halt. Like, we entered 2026 with a record low of just 30 million square feet of new retail space under development across the entire country.
Wait, 30 million across the whole U.S.?
Yeah. To put that in perspective, in a normal year, we would usually see somewhere between 80 to 100 million square feet delivered.
Oh, wow. So the pipeline is practically non-existent.
It really is.
Yeah.
And of that tiny 30 million square feet that's actually being built, over 70% of it is single-tenant formats.
Like the Raising Canes.
Exactly. It's the drive-thrusts, the standalone banks, the QSRs. Developers are just not building multi-tenant strip centers right now.
Because of the costs, I imagine.
Right. And because of this absolute drought of new supply, the national retail vacancy rate is incredibly tight, hovering somewhere between 4.3% and 5.0%.
Okay, but if the entire country is practically out of retail space, it makes zero sense that Spokane has a negative 222,000 square feet of absorption. Like, are local tenants here just failing at a massive rate?
Not at all. That number is heavily skewed by a few very specific events. The biggest one, by far, is the former Burlington Coat Factory.
Okay.
That is one single building, and it accounts for 146,000 square feet all on its own.
Oh, wow. That's a huge chunk of the negative number.
Yeah. Burlington downsized into a smaller footprint in the exact same center, and that massive old box isn't sitting empty waiting for a new retailer to move in.
What's happening to it?
It's currently being converted into a self-storage facility.
Okay. That changes the math completely. So absorption isn't just a basic measure of empty space versus occupied space again.
Right. Net absorption measures the change in occupied retail space. So when a 146,000 square foot building stops being retail and becomes self-storage, the formula counts that as 146,000 square feet of negative retail demand.
Even though it wasn't a bunch of local businesses failing.
Exactly. The space was permanently removed from the retail inventory. And then you add in a wave of national bankruptcies that hit recently, brands like Rite Aid, Jocan, and Big Lots closing their doors. And that accounts for basically the rest of the negative absorption.
So it's corporate restructuring at the national level, not a failure of the local Spokane consumer base.
You hit the nail on the head.
That makes a lot more sense. It's kind of like walking into a popular restaurant and seeing a huge section of the dining room completely empty. Your first thought is, oh, this place must be failing.
Right, because there's nobody sitting
Yeah.
there.
But they aren't failing. They actually just permanently walled off half the dining room to build a bigger kitchen. The supply of tables just shrank forever, but the people waiting in line at the door are still there trying to get a seat.
Walling off the dining room is the perfect way to think about it. The fundamental demand for the remaining space is incredibly high.
Okay.
And from a data analysis standpoint, this is really just a temporary distortion. These ghost ship vacancies, like the Burlington conversion, they only stay in the trailing 12-month data for 12 months.
So they'll age out of the stats soon.
Exactly. As we move through 2026, those isolated events will roll off the statistics. When they do, you are going to see that negative absorption number rebound sharply, and the headline vacancy rate will suddenly reflect how tight the market actually is.
Okay, so if local supply is incredibly tight and existing footprints are permanently shrinking, Standard Economics says developers should be swarming Spokane to build new multi-tenant spaces to capture all that pent-up demand.
You would think so, yeah.
Why aren't we seeing construction cranes everywhere? Why is the pipeline completely dry?
It all comes down to the cost of capital. Developers want to build, but the debt markets just aren't cooperating.
We hear constantly that money is expensive, but what is actually driving that at this specific moment in Q1 2026? Like, what's the mechanism?
Well, the Federal Reserve paused their rate cuts, holding their target range at 3.50% to 3.75%.
Right. And they paused because of inflation, I'm guessing.
Yeah, specifically, the catalyst for that pause was the oil price shock from the Iran conflict in the first quarter. Elevated energy costs pushed the Fed's PCE inflation forecast, which is their preferred measure of how fast prices are rising back up to 2.7%.
Which is stubbornly above their 2% target.
Precisely. Because inflation remains sticky, the yield on the 10-year Treasury is hovering around 4.35%. And it's not just inflation pushing that yield up either.
What else is there?
There is massive supply pressure from the recent One Big Beautiful Bill Act, which is basically flooding the bond market with new Treasury issuance.
And more supply of bonds means the government has to offer higher yields to attract buyers.
You got it.
Okay, let's translate this back to the real estate market for the listener. When the 10-year Treasury is at 4.35%, how does that freeze new construction or freeze the big institutional buyers? We mentioned earlier that the average cap rate in Spokane is 7.4%.
Right.
So if Wall Street buyers and massive real estate investment trusts, the REITs, if they need yield, why aren't they flooding into Spokane to buy up assets at 7.4%? That seems like a good return.
Because institutional buyers rely on highly complex, heavily leveraged capital stacks. They are borrowing massive amounts of money to fund these acquisitions. Historically, they needed to underwrite deals at sub-6% cap rates to make their math work and satisfy their shareholders. But when their borrowing costs surge because the Treasury yield is at 4.35%, the spread between what they pay for money and what the property earns simply isn't wide enough to justify the risk.
So they just stop buying.
Exactly. They are paralyzed. They are sitting on the sidelines.
You know, this is where I think a lot of listeners might feel a sense of whiplash.
How so?
Well, if you're listening to this and kicking yourself for not refinancing or buying more property in 2021 when money was practically free, the phrase higher for longer sounds like a total disaster.
Oh, for sure. It sounds like the sky is falling.
Right. But is this an actual crisis, or are the massive institutional buyers just struggling because we all got spoiled by 0% interest rates for a decade?
Honestly, it's the latter. The institutional players are certainly struggling, but for the local private investor, this market is highly functional.
Really? How are they making it work?
Institutional buyers might be paralyzed, but, a local dentist or a regional investment group looking to buy a strip mall, they operate differently. They're using moderate leverage, putting down a substantial amount of cash, say 35% to 45%, and taking out a loan for the remaining 55% to 65%.
Gotcha. So they aren't trying to squeeze pennies out of massive, crazy leverage.
Correct. When a private buyer looks at a local asset generating a 7.4% cap rate and compares that to a 4.35% borrowing cost, they see a spread of roughly 300 basis points.
Meaning a flat 3% difference between the property's yield and the baseline cost of money.
Exactly. That is a very healthy margin for someone who is actually willing to put down a solid chunk of equity.
Which perfectly explains why local players are stepping into the void left by Wall Street.
It's incredible to see in the data. A staggering 94% of buyers in the Spokane retail market right now are private investors.
Wow, 94%.
Yeah, they have entirely monopolized the landscape, mostly playing in the sub-$5 million sandbox, where the big institutions don't even bother looking anymore.
Okay, let's follow that private money. If they are the only ones playing, where exactly are they putting their chips? Let's look at the actual transaction receipts from the data.
The transaction data reveals a heavily bifurcated market. We are seeing two very distinct investment strategies playing out right now, and the pricing gap between them is massive.
Okay, we'll start with the premium end of the pool. Let's bring back that deal from our cold open. That Raising Cane's on North Newport Highway, which, to be clear, was actually a prior quarter deal from September 2025.
Right, but still highly relevant.
It traded for roughly $4 million at a 4.6% cap rate.
Yes, that is what we call a single-tenant triple-net lease.
We should probably define that for the listeners. Triple net is basically the holy grail for passive investors, right?
Essentially, yes. A triple net lease, or NNN, means the tenant is responsible for almost all of the property's expenses. They pay the real estate taxes, the building insurance, and all the maintenance.
So if the roof leaks, the tenant fixes it.
Exactly. If the parking lot needs paving, the tenant paves it. The landlord simply collects a rent check every single month. When you combine that structure with a brand new building and a highly creditworthy national tenant like Raising Cane's, you have the ultimate sleep well at night asset.
So the buyer is paying a massive premium, accepting just a 4.6% yield just to outsource all their headaches?
That's it. They are buying absolute certainty. Now compare that to the core asset profile in the CoStar data. An Apple store at River Park Square Mall sold between private investors for roughly $5 million.
Okay. And what was the square footage on that?
That breaks down to about $300 per square foot.
So a very different risk profile than a standalone drive-through, but it still commands a solid premium.
It commands a premium because of the tenant's global credit rating and, of course, the prime central location of the asset. But finally, let's look at the other side of this bifurcation.
What's over there?
The Valley Essential. The data shows a 14,700 square foot drugstore in Spokane Valley sold for about $4 million, which comes out to around $270 per square foot.
The pricing gap here is what really jumps out at me. We have credit-backed, single-tenant properties compressing down to the 4% to 6% cap rate range. But at the exact same time, the broader data shows multi-tenant neighborhood centers in Spokane, your classic strip malls with a mix of local hair salons, restaurants, and regional businesses. Those are trading between 7.0% and 8.0%.
Yep. The spread is entirely dictated by the lease structure and the amount of work required from the owner.
I mean, think about your own portfolio for a second as you're listening to this. Are you willing to accept a 4.6% return just so you don't have to worry about replacing an HVAC unit or, chasing down 3 different local businesses for rent checks every month?
A lot of people are.
Right, because based on these transaction numbers, private capital is perfectly willing to pay that premium for peace of mind.
It is the literal cost of passive income. If you want a hands-off investment, the market demands you accept a lower cap rate.
Right.
But if you are willing to roll up your sleeves, manage multiple leases, handle the maintenance of a multi-tenant strip center, and take on slightly more risk with non-corporate tenants, the market rewards you with a 7% or 8% yield.
It really is a choose-your-own-adventure market for private buyers right now.
It really is.
Well, before we wrap up this deep dive, I want to look forward. Based on this Q1 2026 data, what are the specific watch items we need to be tracking for the rest of the year?
There are 2 major metrics to monitor. The first is the stickiness of inflation and the Federal Reserve's response.
Okay.
If the Fed is genuinely forced to wait until the fourth quarter of 2026 to cut rates, which, by the way, is what the bond market is currently pricing in, we can expect private capital to completely dominate the Spokane market for the rest of the year.
Because the big guys are stuck.
Exactly. As long as the 10-year Treasury stays elevated, institutional buyers will remain sidelined, leaving a clear, uncontested runway for private buyers to pick up local assets.
And what's the second watch item?
The absorption rebound. As we detailed with the Burlington self-storage conversion, the data strongly suggests Spokane is basically at its vacancy trough right now.
Right, waiting for that ghost ship to sail.
Yes. As the shock of that massive 146,000 square foot removal fades from the trailing 12-month metrics, the headline vacancy rate is going to tighten significantly. Once that statistical distortion is gone, the severe lack of new multi-tenant construction will become glaringly obvious in the local data.
Which leaves us with a really fascinating dynamic to consider. National retail construction is at a record low of just 30 million square feet. Developers can't afford to build new multi-tenant strip centers because of borrowing costs.
Yeah.
Meanwhile, large obsolete boxes are being permanently removed from the retail inventory and converted to other uses.
So the supply is essentially frozen, and in some cases actively shrinking.
So the existing, well-located multi-tenant strip centers in Spokane are suddenly becoming an incredibly scarce resource.
Absolutely.
Are we quietly entering a golden age for landlords who simply hold on to well-maintained, middle-market retail centers? Because the lack of future competition is practically guaranteed by the current capital markets.
I mean, it is a classic supply and demand bottleneck. If nobody can afford to build your competition, the existing supply you already own becomes exponentially more valuable over time.
That is definitely something to think about as you evaluate your own holdings. In a market this divided between the single-tenant premiums and the multi-tenant yields, having a localized strategy is just vital.
You really cannot rely on national headlines. You have to analyze the micro-location, the specific tenant credit, and your own debt structure on a case-by-case basis.
Which is exactly why having a local expert parse this out for your specific situation is invaluable. For a custom market breakdown, contact Eric Peterson at 509-903-9077.
It's the best way to get a clear picture.
For sure. Again, that's Eric Peterson at 509-903-9077. Thank you for joining us on this deep dive into the numbers, the narratives, and the reality of the Spokane market. We will catch you next time.